Hi everybody, welcome to another video. Today we're going over how you can start investing in 2020. Before I go on with the rest of the video, if you haven't subscribed yet, I post a lot of finance videos, and if you like to learn about finance or are interested in it, this will be a great place for you guys to learn. As I was writing up the script for this, I was thinking about the different types of people who want to invest. So I've calculated mathematically that there's 5 different people who want to invest. You want to invest, but you might have debt, you might be low on cash, you're afraid of losing all your money in the stock market, and you want your money to be liquid. The fourth type is you want to dabble a little bit with the stock market, but you don't want to do research. And last but not least is you want to invest in the stock market and you're up to doing a little bit of research. Oh, Andrew from the future here. I have my cat. And we're going to put the timestamps below if you want to skip to which investor do you think that you are or that you want to be. So, yeah. This might be a great time to go down into the comment section and type out which type do you think you are out of those 5. It'd be really interesting to hear, and I'll make sure to reply to all your stuff down there. So the first type of person we have that wants to invest is someone who has debt. So the best return on investment you're going to get if you do have debt, and that includes credit card debt, personal loans, student loans, just any type of debt that puts you into the negative, the best way for you to invest right now is for you to pay off those debts. Having a 22% APR or any type of interest is going to be really hard. I'll talk about this in a future video, but Dave Ramsey recommends either the debt snowball or the debt avalanche. I recommend the debt avalanche, which pretty much is you pay the minimums on all of your debts, and whatever money you have extra, you tackle the highest interest debt after that, which essentially allows you to avoid paying a lot of interest in the long run. So the pros of this way of paying off your debt first is it'll allow you to pay less interest in the long run. You'll feel that you have a huge weight off your shoulders once your debt is actually gone. And over time, it'll allow you to increase your credit score. And the only con I can really think of is that you do miss out on some possible gains through the stock market or through other ways we're going to talk about, but I recommend paying off all your debt first. So the second type is someone who's kind of strapped on cash or low on cash. And for this, I really recommend you investing in yourself. Graham Stephan has a really good video where he talks about how to invest your first $100, which is something that I followed even though I already had a few $1,000s invested in the stock market. So Graham Stephan recommended a lot of books in there, but these are some of the ones that I read. We have How to Win Friends and Influence People, Your Money or Your Life, and last but not least we have Think and Grow Rich. This was probably my most helpful book. And all these books you can buy for really cheap on eBay. There's an eBay called Thrift Books, which I'll link below. But also, if you don't want to pay, there's a lot of free alternatives. If you want to learn how to code, there's Free Code Camp, there's Udemy, and there's even a lot of YouTube resources out there. I really recommend The New Boston. He's a great YouTuber. Probably one of the best cheap ways you can start investing into yourself right now is watching UCSD's video from Coursera, Learning How to Learn. It's something I wish I knew when I was in college and something that I learned after college, which is still very helpful no matter how you cut it. You can find the links to all the things that I'm talking about down below in the description. The third type of individual we have who want to start investing is the people who are afraid of the stock market and or want their money to be liquid. The best advice I can give to you is to open a high interest savings account. A lot of the big banks like Wells Fargo, Chase, or Bank of America, they have very low interest rates, 0.01%. So essentially for every $100 you put in there, you get 1 penny every year. There's a lot of online banks such as Ally, Betterment, Marcus by Goldman Sachs, which I personally have, and Wealthfront, which allow you all to get great returns on your investment. Ally has like 1.6% and the other 3 have a 1.7% or more APY. For every $100 you put in with Marcus, you'll be getting $1.70 back because they have a 1.7% APY. A lot of people like this one just because your money's liquid, so you can grab it whenever you need it to. Because it is important to note that the rates do fluctuate. It might be 1.7% right now for Marcus, and a year from now it might be back to 2% or it might be down to 1.3%. We just don't know. An alternative to this is if you have money that you know you're not going to need for a year or two or for a set amount of time, you can get a certificate of deposit, which allows you to get a higher interest rate, but your money is kind of stuck in there until it matures. So the fourth type of person we have is the person who wants to start to dabble with the stock market, but they don't want to do much research. The best time for you to start investing in yourself or your money is right now, because over time, even though the stock market fluctuates up and down, you're always going to come out on top. Unless we go into a World War III and everything dies. So the best way for people to invest who want to dabble but not do any research is through low-cost index funds or ETFs. For example, all of my retirement or 401k is in VFAX, which is a Vanguard index fund. And there's also VT-SAX, and there's a few other index funds out there that I'll link below. An index fund is essentially an accumulation of different assets. And if you look at Vanguard and you look at their ETFs, they'll give you a breakdown of what is exactly in the ETF. So for example, there might be Microsoft, Amazon, Google. There might be a bunch of bonds. There might be some real estate. It really depends on what you choose. For you to buy an index fund or an ETF, you're going to need to have a brokerage. So the way that I started out was I had Robinhood. Robinhood's a great free application on the Apple or Google store. I personally moved from Robinhood to Schwab after they started having $0 commissions. But if you're going to do exclusively index funds and not play around with stocks, and you know you're only going to go for Vanguard index funds, I recommend opening up a Vanguard brokerage account just because they waive a lot of the fees. So if you have Schwab and you try to buy a Vanguard index fund, they're going to charge you. Just a word of caution though, if you do go for an index fund, there is a steep introductory minimum that you need to put in. I believe it's $3,000. But if that does scare you away, the alternative is an ETF, which a lot of these index funds can be found as a lower cost ETF. So if you're worried about having to do a lot of research, it's as set it and forget it as you're going to get. No matter what, you're going to be getting the market average, which over the last 10 years, even with all the peaks and valleys, it's been, I think, 7 to 7.5%. But a huge word of caution, nothing is guaranteed. You might be up 10% in a year. You might be down 14% in a year. You don't know. This is definitely more risky than having a high interest savings account or a CD, but I believe it's a good sweet spot of being aggressive and being conservative with your money. Last but not least, we get to the fifth person, is someone who wants to do a little bit of research and buy individual stocks in the stock market. Before I go on, I just want to tell you that I'm not a pro at stocks. I don't claim to be. I'm just an average Joe who's been buying stocks and who's made a pretty okay return. So there was a comment I saw on Reddit a long time ago that I've kind of been sticking to as my philosophy. Basically, it's don't be ashamed to stick to winners that have a huge moat. So for example, that's like Microsoft or Visa or Waste Management. Big companies that have a moat of money that have increased their dividends from year to year or that continue to have increased revenue, those are winners to me, and I think that those companies will be around in 10 years. So to do your own research, there's a lot of ways to do it. Schwab has a really nice platform to allow you to do research. There's MarketWatch, which allows you to get a bunch of different information from stocks that you follow and just big news overall. There's Yahoo Finance, which is really good. But I do not recommend getting your information from Reddit, so Wall Street Bets or r/investing, or even Stockwits, which I believe is like a social media where people tweet about their ideas for different stocks. When you're doing individual investing, something I've learned from one of the books I'm currently reading is that there's a lot of speculation in the stock market. So someone might say, oh, well, since tires are getting taxed now, there's going to be less people driving. And since there's less people driving, there's going to be less need for oil, which, the gas prices are going to cramp or something's going to happen with the oil industry. So oil stocks tank. But that's just speculation and you don't know it yet. There's no concrete evidence. And the only concrete evidence you really get is through numbers. So the way I see that is all through revenue, or if a company like Microsoft gets their Microsoft Teams into another huge company, then that is not speculation, and those are some cold hard numbers that I can get behind. Another caution for this one is do your research and don't be an emotional trader. The stock market's going to go up, it's going to go down, but you need to be resilient and not sell just because your stock's down. I've lost a lot of money that way, and I would hate to see for all of you to lose money that way too. So that's everything I got for you guys today. Thank you so much for listening to it. Please let me know, what kind of investor do you think you are, and what kind of investor do you want to be? And once again, don't forget to like, comment, and subscribe, and to go tell a friend, because the only way to learn about investing or to learn about finance is to be taught it. And I really hope that I'm allowing this to be a platform for all of you. And I'm like moving my chair around a lot. But yeah, thank you so much. Have a nice day. Okay, bye everybody. Oh.